Most traders think the first supply zone they see is the best place to sell. It looks clean, it looks respected, and everything suggests that price should reverse from there. But in many cases, that's exactly where traders get trapped. Price doesn't fall. Instead, it continues moving higher, takes out their stop loss, and only then begins the real bearish move. So, was the first supply zone actually wrong? Not at all. The problem is that traders were focused on the wrong supply zone. In this breakdown, I'll show you how to identify the supply zone that smart money is actually waiting for. Now, let's take a look at this first supply zone. At first glance, it looks like a high probability area to sell. Price has reacted from this level before, so it's easy to understand why many traders become interested in taking short positions here. As price returns to this zone, a lot of traders expect an immediate bearish reversal. But this is where an important mistake happens. Just because a supply zone looks valid doesn't mean it's the supply zone that smart money wants to use. So instead of selling immediately, let's watch how price behaves around this area before making any trading decision. Now, before price moves any higher, I want to mark this higher supply zone. This is the area I'm actually interested in, because I believe institutional sell orders are still resting here. So, instead of focusing only on the retail supply, I'm also paying close attention to this higher supply zone. Now we have two different supply zones on the chart. The first one is where most traders expect the market to reverse. The second one is where I'm expecting smart money to become active. At this point, we don't know which supply zone price will respect. So let's continue following the price and see where the real bearish reaction begins. Now, this is where things start to get interesting. At this point, we have two different supply zones marked on the chart. The retail supply is the first area price is approaching, while the higher supply is still waiting above. Now, if the retail supply is truly the right place to sell, then price should react from here and start moving lower. But what if it doesn't? What if price completely ignores this supply zone and keeps pushing higher instead? Does that mean the retail supply was invalid? Or is the market simply moving toward a more important supply zone? Let's continue following the price, because the next move answers that question. Now price has finally reached the retail supply zone. This is exactly where most traders become confident that the market is about to reverse. The reason is simple. Price is returning to a respected supply zone, so many traders believe this is the perfect place to enter a sell trade. But instead of respecting the zone, price breaks straight through it and continues moving higher. This is the point where many traders start questioning their analysis because the market isn't behaving the way they expected. However, the problem wasn't the analysis. The problem was choosing the wrong supply zone. This retail supply wasn't the area where smart money wanted to sell. Instead, it was encouraging traders to enter early while price continued moving toward the higher supply zone. In other words, this retail supply zone was acting as an inducement, drawing traders into premature sell positions before the market reached the real institutional selling area. Now let's see what happens once price finally reaches that higher supply zone. Now price has finally reached the higher supply zone. At this point, most traders think this is where I enter the sell trade. But this is another mistake that many traders make. Just because price has reached my supply zone doesn't mean I'm ready to sell. A supply zone only tells me where to look, not when to enter. So instead of rushing into the trade, I wait for one more confirmation. And that confirmation is what separates a high probability entry from an emotional one. Now that price has reached the higher supply zone, I'm still not interested in entering the trade immediately. This is one of the biggest mistakes traders make. They see price touch their supply zone and instantly open a sell position. But that's not how I trade. I always wait for a more refined execution area before making any decision. In this case, price gives me this POI. Normally, I would refine my entry using an order block or a fair value gap. However, neither of them formed here. So instead, I use this POI as my refined area of interest. Now there's only one thing left. I need confirmation that sellers have actually stepped into the market before risking my capital. Now price has returned to my POI, but I'm still waiting for one final confirmation. A few moments later, the market prints a strong bearish displacement. For me, this is the confirmation I've been waiting for. It tells me that sellers have finally taken control after price reached the higher supply zone. That's exactly where I execute my sell trade. My stop loss is placed safely above the higher supply zone, giving the trade enough room to work. For the target, I'm aiming for a fixed 1 to 3 risk to reward. At the same time, notice the sell-side liquidity resting below the market. That liquidity adds extra confidence to the trade because it gives price a logical objective. Now, the trade is active, and all that's left is to let the market do its job. Now the trade is active, and this is where patience becomes the most important part of the entire setup. After entering from the POI following the bearish displacement, price starts moving exactly as expected. Notice how the market begins creating strong bearish candles. This isn't a random move. The bearish displacement already gave us confirmation that sellers had taken control, and now the market is simply delivering in that direction. This is exactly why I never sold from the retail supply zone. And it's also why I didn't enter the moment price touched the higher supply zone. I waited for the market to confirm my idea first. That single decision helped me avoid an early entry and gave me much more confidence in the trade. As price continued moving lower, my target remained the same. I wasn't chasing every candle, moving my stop loss unnecessarily, or changing my plan because of emotions. My trading plan was already defined before I entered the market. A fixed 1 to 3 risk to reward was my objective, and all I had to do was let the trade play out. A few candles later, price reached my target exactly as planned. Could price continue lower toward the sell-side liquidity? Of course, it's possible, but that's not the point. A professional trader doesn't stay in a trade because of hope. A professional trader follows the plan that was created before the trade was ever opened. That's the lesson I want you to remember from this setup. The best entries don't come from reacting first. They come from waiting for the right area, waiting for confirmation, and then trusting your trading plan with discipline. That completes the entire setup. From identifying the retail supply to waiting for price to reach the higher supply zone, refining the entry with the POI, and finally entering only after the bearish displacement. Every step had a purpose. Remember, trading isn't about entering every supply zone you see. It's about understanding which supply zone smart money is actually interested in and having the patience to wait for confirmation. If you can apply this concept with discipline, you'll avoid many unnecessary losing trades and make better trading decisions over time. If you enjoyed this breakdown and want more smart money concepts explained in a simple and practical way, don't forget to subscribe. I'll see you in the next video.